the UK Tax Podcast, Tax Implications in Divorce Settlements, with John Kavanagh. Welcome back to the UK Tax Podcast. My name is John Kavanagh and I am a chartered tax advisor with my own private practice. I mainly advise other professional advisors but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. In today's episode, we will focus on the tax implications arising from divorce settlements, covering topics including the transfer of equity, capital gains tax, CGT implications, and practical considerations to minimise tax liabilities. Firstly, the capital gains tax implications. When a marriage or civil partnership ends, financial arrangements often involve the transfer of assets between the parties. Under UK tax law, transfers between spouses or civil partners living together are treated as occurring on a no gain, no loss basis, meaning no CGT liability arises. However, this favourable treatment only applies up until the end of the tax year in which separation occurs. For example, if a couple separates in June, they only have until 5th April of the following year to transfer assets without incurring capital gains tax. Beyond this point, any transfers may be subject to capital gains tax based on the market value of the asset at the date of transfer. It is therefore essential to plan asset transfers carefully and within the applicable timeframe to avoid unnecessary tax charges. Next, a few brief comments about the transfer of equity. The family home often represents the most significant asset in a divorce settlement. Transfers of equity, particularly when one party retains the property while releasing the other, can have both CGT and SDLT implications. CGT may be mitigated if the property has been the main residence of the transferring party, thanks to Principal Private Residence Relief, PPR. However, this relief has limitations if the property has been let out or used for non-residential purposes. SDLT may also arise where one party takes on a greater share of an existing mortgage as part of the settlement. This is treated as consideration for SDLT purposes, and if it exceeds the relevant threshold, SDLT will apply. Finally, inheritance tax considerations. Transfers between spouses or civil partners are generally exempt from inheritance tax, but this protection ceases once the marriage or civil partnership is legally dissolved. Couples should therefore consider the IHT implications of retaining or transferring assets and whether the use of trusts or other estate planning mechanisms might be beneficial. In conclusion, navigating the tax implications of divorce settlements requires careful planning and professional advice. The financial and emotional stakes are high, but with the right guidance, it should be possible to achieve a fair settlement while minimising tax liabilities. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next and future episodes.